Mahesh Patil joins us. Let's connect with him. Let's understand what he makes of the current market setup. Mahesh, good morning. Thank you for joining us. It's getting bad and terrible in some cases. Will it get worse before it gets better? Or you think we're nearing this panic bottom?
Yeah, good morning. So we have seen, a good amount of sell-off in the global markets have seen a very good correction. In a way, a lot of the negatives which are there are to some extent priced as it looks like, because whether it is rate increases, inflation, global growth slowdown, earning downgrades, all these are to extent known. So I think market should probably take some support over here, looks like. On a valuation basis, also now the correction in the derating in P multiple, which was expected on the back of increase in interest rates, that has also happened to a large extent, because now the valuation multiples, if you look at on a trailing basis, would be somewhere near to the long-term average, 10-year average multiples. Though on a price to book value, it will be slightly expensive. So I think for the time being, it looks like the market should probably consolidate. But I think the fact is that there has been significant slowdown, both in global growth. In India also, we haven't seen much downgrade, but I think you could see because of the current impact of increase in interest rates and inflation, it will have in growth and also on earnings downgrade. So I think to that extent, and the fact that at least for the next few months, the Fed at least has said that they will continue with their at least 50 basis point rate hikes in the next two policies. So in that environment, I think while market looks to be in the fair zone at this point in time, but it can always undershoot on the downside, looking at the sentiment and the growth outlook has weakened. And to that extent, I think one should be prepared for more downside over here. But I think for investors who are looking to really invest from a long-term perspective, a lot of stock prices have now corrected to very good levels. I mean, we've seen huge correction in individual stock prices. And I think it's a good time to now start looking at individual stocks where the valuations are attractive and where the earnings outlook is not really impacted to that extent.
Mahesh, we are in earnings downgrade cycle, and that downgrade cycle will last, let's say, for another 2 or 3 quarters. So why do you think markets should come back? Because now estimates are getting challenged. They're getting challenged across the board. They'll get challenged for IT, metals, autos. So what is the bull case scenario? If earnings are contracting, why should markets go higher?
So I think as the markets always look slightly beyond the next few quarters, right? And that's what it is, even in the correction also. And similarly, okay, when they bottom out and start to look forward. So I think once it gets a sense that whatever the growth slowdown, what we're witnessing is getting priced into the earnings downgrade, which probably will happen, I think, by the end of this quarter, or probably the second quarter. I think you should see that in the earnings. And then I think one will take a cue from there, how the valuations are looking and what's the overall outlook. But even before that, I would say the reason for the markets to correct has been the high inflation, right, which has prompted the policy makers to really go aggressive in terms of rate hikes and also in terms of decreasing the liquidity. So if inflation numbers starts, I think inflation looks to have peaked out at least globally. And if it starts to really cool off significantly than what one is expecting, I think then market will start to believe that the whole, because the bond yields are already factoring in a very large rate hike cycle. But inflation starts to surprise, but possibly on the downside, then I think market will take a belief that the rate tightening, which was expected, I think might not go to the full cycle. And that could be a reason for the markets to really start bottoming out and looking forward. So I think that is, important to look at how the inflation print pans out, because obviously the demand destruction which is happening will have an impact in terms of prices. And I think that is now starting to get seen in the US data, which came in a few days back, is showing there is a material slowdown over there.
Sure. Mahesh, so just, trying to understand that what would be the right asset allocation at this juncture? And for those of us who invest in SIPs, wanted to understand what could be the right breakup. I mean, do you have a larger exposure to large caps? Do you still go for multi-cap funds? And what do you do then with debt?
Yeah, so I think, as I mentioned, the markets now are in a fair value zone, right? So it's neither expensive. 6 months back, we were looking at the markets were trading above, say, one standard deviation above or more compared to the long-term average. Now they are in the fair zone. So in that context, overall allocation to equities, we are suggesting that it should now be in line with your normal target allocation. That means if your target allocation was say 50, depending on a risk profile, I think you should now probably getting closer to that level. Even there could be say around small downside from these levels, because you never know where the market will bottom out. But within equity also, I think the larger allocation is still suggesting is that should be in a large cap and a flexi cap fund or a multi cap fund, because that's where I think there is still some amount of uncertainty. We're seeing a lot of sectors, the outlook there is still pretty unclear because of the supply side disruptions. So the larger cap space, which has seen also a meaningful correction after the FIS selling, but will provide more stability to the portfolio. So say around 50-60% allocation to a large cap, a multi-cap and a flexi-cap fund. Mid-cap and small caps have seen a good correction, almost 23% down from the recent peak. But near term, I think they could still be volatile, but with a 3-year view, I think it's also a good time to start slowly making investments in the small cap and mid-cap space. Say around 15-20% in the mid and small cap space is what one would recommend.
Okay. Mahesh, let's understand the pain in IT. IT companies are growing, valuations are not that stretched, but that sector has just got completely bombed out in last 2-3 months. What is that we are missing right now?
So actually, you're right. I think IT sector again is following what's happening in the US, right, in the Nasdaq, and we have seen decent correction in all the technology stocks globally, and there is a good correlation between Indian IT companies and the global IT names. So what we are seeing is essentially a P derating. I don't think there is a big downgrades to earnings and impact over there. So you're right. I think IT sector still offers a fairly good amount of visibility over the next 2 years. I think market is fearing that because of US growth slowing down and some probability, say around 25% probability of a US recession. So that will start hurting the discretionary spends and towards the IT sector. But mind you, IT spend this time are more towards growing the business, and which is not like that, more towards digital, towards cloud migration, towards cybersecurity, which is not likely to get impacted as much. So I think the sector now, I think it was kind of trading way above its long-term average P multiples, and rightfully so because of this strong growth outlook. But with the recent correction, what we have seen in the IT sector, I think the sector offers a very good risk reward here because, we're not seeing any major downgrades to earnings. There is some margin pressure, but rupee is also likely to depreciate. We see rupee depreciating a bit from here, so that should offset that. And these companies are generating very good free cash flow. So I think the market should be focusing on companies where free cash flow generation is strong, and most of the large IT companies are now at a free cash flow yield of around 4% or 5% or so. So I think it was more to do with what's happening in the sell-off in the global IT names. But I think Indian IT companies, the way they are positioned, looks like at least on the growth side, one doesn't see much of a problem over there. So I think they offer, I think at these levels now, fairly good risk reward from here on. So I don't expect any further re-rating from these levels, at least for the large IT names.
Good morning. So just to clarify, that's for the large cap IT names that you're talking about. You got a Wipro flirting with a 52-week low. There's 1 rupee a share higher than that. Infosys trading at a 20-time forward earnings. You've got TCS about 23 to 24 times. You're talking about the large caps or the mid cap, which had turned out to be far more expensive.
So I think now with some headwinds looking into the sector, okay, in terms of slight amount of growth, discretionary spends, I think mid-cap ITs could be slightly vulnerable. I think the pressure there also on the cost side, okay, when you're seeing tight market on the labor side, I think they could probably face some challenges over there. And normally when we see the sentiment, which is still a bit negative, the mid-cap ITs tends to correct more, and the contraction in the multiple is much larger over there. And we've seen a good amount of expansion in multiples in the mid-cap IT names in the last 2 years. So there could be some more room for the P correction, which is still there. So from that perspective, I would stick in this environment more towards the large cap IT names.
he'll gravitate towards the large cap IT names. What about banks? The leadership change, do you see that now actually being a reality and the way to go?
So banks, again, we've been positive on banks now because, again, we're not seeing any major downgrades to earnings in that sector, at least for the time being. And overall, there have been some concerns about, because rates have gone up, okay, there could be some impact on the mark-to-market losses on the on your securities. But I think in the initial period, I think the increase in the interest rates is probably positive for the banks on the NIM side, where you've seen faster transmission of the rate increase on the asset side and the increase in the rate on the liability side is much slower. So that should be okay. Credit growth is still sluggish, but it is improving. So that should help the top line growth. And we are not seeing any major increase in these stress levels. So I think, and the valuations of the large, again, all the banks actually are also fairly reasonable. So I think it's time that it's underperformed recently, that whenever there is a risk off globally, we see banks getting hit the most. But fundamentally, I think banks look fairly comfortable, both from a valuation perspective and also in terms of the earnings outlook perspective.
Mahesh, are there any traces of redemptions in schemes now? Touchwood, so far DIs have been buying, but it's been almost a 1 year window for a lot of schemes where returns are not there. They're not beating fixed deposits. And that for a new time investor is a question mark. Real estate and equity have always competed. So real estate has not fallen and equities have fallen. Is that leading to some redemption? What is the status?
So at least our observation is that investors are still really continuing to put in their long-term money into equities, not really bothered about the market correction. Yeah, but I think as interest rates are starting to inch up and yields on the debt side or the returns on the bond market start to look attractive, which probably will happen, say, around 3 to 6 months down the line, you will see some rebalancing happening in terms of the overall allocations. But I think more so retail investors, especially the SIP in money which is coming in, I think we are not seeing any kind of slowdown over there. Lump sum investments which were there, I think they have seen some kind of a slowdown over there. But again, as the markets correct, I think you could see some of these investors coming in back as the markets start to look more attractive over there. So by and large, I think we're still seeing steady inflows. As you know, recently in the last, since the month of April, right, we have seen there are no new NFOs which are there. At least SEBI has kept a ban on NFOs for the next, for the 3 months period. So that large push, okay, which was there in the market into the raise money, that has probably slowed down a bit. But I think the normal regular inflows, we're not seeing any signs of that slowing down.
Okay. Mahesh, historically when markets have bottomed out from big falls, either central banks have come into support or valuations have to become attractive. We are in line with the long-term average. So we've not become attractive per se based on historical time, times or historical time periods where markets have bottomed out. And this time central bankers are against you, which is they're moving interest rates higher. So what is the trigger which will change the tide?
So at least, as you rightly said, I think markets can always undershoot on the downside, and we've seen that. So for that, actually, the drivers there are the macro environment, right? What is the overall financial conditions? What is the policy response? What are the central bankers thinking? I think that's where leads to the either over exuberance or the pessimism in the market. And I think that will be key, really. I think valuations they matter, but over a longer term, really. In the medium term, short term, it's the policy environment which is there, okay, which will drive the markets. So it's important to see how the overall central banks globally chart their policy going forward, whether they continue to remain hawkish and trying to really tame in inflation, or whether that stance, okay, becomes less hawkish because inflation is coming down. I think that will be key for the markets to really bottom out and the risk money started to come in and then lifted off from here. So I think that's the important thing to watch out to get a sense where the markets really bottom out.
Right, Mahesh, so good having you on the show. Thank you as always for taking the time out.